You've heard our vision, market opportunity, and the strategy behind each of our ecosystems. Before we take your questions, let's come back to how what we shared today shows up in our numbers. There are 3 core pillars of our business model. First, we're focused on delivering growth at scale. We're building and scaling relevant products that empower customers in each ecosystem with the goal of serving more customers in more ways, enabling us to capture more of the addressable market. Second, we're guided by strong unit economics. And because we seek to deliver value to our customers across an ecosystem of products with differing rates of adoption and monetization, we look at our unit economics on a customer basis. We closely measure the performance of customer cohorts and trends around customer lifetime value as we deploy our investments. And third, we believe our business has attractive structural profitability. At the core of this are the strong structural margins in our primary ecosystems today, Square and Cash App. It's against these 3 pillars that we manage our business with discipline and orient our investments. Let's go a bit deeper in each area now. We evaluate our cohort economics based on our ability to acquire new customers, retain our relationship with them, and provide additional value over time. We acquire customers because of frictionless onboarding, strong word of mouth, and innovative distribution models across multiple entry points in each ecosystem. We retain our customers because we build intuitive products that work seamlessly together in real time, which helps earn trust. Over time, we've seen our customers use more products and engage more with existing products. This deepens our relationship with them and drives greater resilience and value for our business. This approach is how we've been able to scale our business more than 12 times since our IPO in 2015, and more than 5 times since our last Investor Day in 2017. How does that stack up to the industry? Let's compare Square's growth to industry benchmarks indexed to 2017. GDP growth has been strong, growing between 15% and 20% in the US and globally over the last 5 years. Growth in payments volume has been even stronger, up nearly 50% both in the US and worldwide. Since 2017, Square's gross profit has roughly tripled in both the US and globally. Cash App showed an even more impressive 44 times increase in the US and globally, albeit starting from a lower base. We believe this demonstrates our ability to gain share in the industries that Square and Cash App operate in, despite the highly competitive landscape. Let's look at how our unit economics have driven this growth, starting with Square. To illustrate our cohort economics, I'm going to show you 2 Square cohorts of sellers and track their performance over time. On the left, we have our Q2 2015 customer cohort, and on the right, we have Q2 2017. We spent $27 million and $45 million respectively in sales and marketing to acquire these customers. After a year, both of these cohorts generated meaningful gross profit, recouping our initial investment for a payback period of 4 quarters. Now, after 4 years, we've seen steady growth in cumulative gross profit over time. We have invested more to acquire the more recent cohort, which by now is more than 40% larger than the older one. What does this mean in terms of the returns on our investment, or ROI, for those 2 cohorts? After 4 years, each cohort has generated cumulative gross profit of more than 3 times our initial investment. We care most about ROIs because they capture the longer-term arc of a customer's journey. Sellers might adopt more products over time as they grow or as our product set grows, and these ROIs reflect the evolution of lifetime value. When we look at all of our Square cohorts, we see a similar trend around attractive long-term returns on our investment. We've anchored investments in our Square ecosystem around a return of 3 times over 4 years, and we've seen ROIs continuing to increase long after that. Historically, we think we've been too efficient here. At less than 2% penetration of the potential market, we've been increasingly opportunistic recently by investing where we see attractive long-term returns. You heard from Alyssa about our expanding go-to-market strategy for Square, with investments across brand, awareness, sales, and global markets. Part of what's driving our returns has been our ability to retain sellers. We've achieved positive gross profit retention for each of our quarterly and annual cohorts since 2012. Even if some sellers might churn, others grow and adopt new products, such that each customer cohort has become a growing annuity stream for Square. This positive retention means that even without any new customers, our revenue base would grow every year based on our existing customers. This trend has held true for older cohorts, which were mostly micro sellers, and for newer cohorts, which have indexed to larger sellers. It stayed true as our cohorts have grown in size, with newer cohorts being larger than those preceding them, and it stayed true in challenging years for our sellers, like in 2020, with the impact of the pandemic. We've seen our ecosystem help sellers adapt to become stronger in 2021. Our positive gross profit retention is rare in our industry. Looking at industry benchmarks, you'll see that average retention is negative for merchant acquirers and public SaaS companies. Again, these are the markets we believe we're gaining share in. I talked before about the ability for customers to grow with our ecosystems. And in fact, about 1/3 of our larger seller GPV comes from sellers that were once in the micro category. Let's look at how we've seen this play out, using an example based on an actual Square retail seller. This seller started out using us in one location and only for payments. Happy with their experience, they brought us to another location the next year. They began by using our point-of-sale software. As they expanded their inventory and hired more staff, they added Square for Retail to customize categories and help manage complexity. As demand grew, they created a website using Square Online and seamlessly synced their products from Square for Retail. When a larger retailer opened up nearby, our seller created a loyalty program, which their customers could manage through their Cash App accounts. To bill some of their customers remotely, they turned on Square Invoices, and finally, they accepted a Square loan, which they used to invest in new plans for expansion. This example shows the power of our ecosystem for our sellers and for us. This seller was able to expand their business in new ways, and as they did, our gross profit increased by 3 to 4 times. A similar trend extends to the overall Square business. You can see our business mix has shifted over time. In 2015, most of our gross profit came from sellers using Square for payments and not software. By 2021, as we grew with larger sellers, software and integrated payments became our largest revenue stream. And each of software and integrated payments, banking, and international have grown much faster than standalone payments, gaining share. We expect this mix will shift further as we continue to grow upmarket and help our sellers grow. Since our IPO, we've expanded the Square ecosystem meaningfully. As we've launched more products and scaled our investments, we've nearly doubled our active seller base and almost quadrupled our average gross profit per seller, creating a powerful compounding effect to drive growth. This is a demonstration of the increasing utility of our ecosystem across a widening range of sellers. Now let's shift to Cash App. You heard from Brian about the 3 key drivers of Cash App's business model: actives, inflows per active, and monetization rate. We're going to dive deeper into each of these and how they relate to Cash App's cohort economics. We'll start with actives. We scaled Cash App to 46 million monthly actives by the end of March. Monthly actives have grown 3 times over the past 3 years and more than 6 times since 2017. Similar to Square, we've achieved this remarkable customer growth with an efficient cost of acquisition. In 2021, we spent approximately $10 to acquire a new transacting active. As you've heard from Brian, the virality of our peer-to-peer network is at the foundation of the efficient acquisition we've seen. We enhance peer-to-peer with acquisition spend in a range of areas, including referrals and incentives to enhance network growth, brand and social investments to drive awareness and bring Cash App's aspirational brand to life, and paid marketing, which is a newer and scaling channel for us. Together, these make up our $10 cost of acquisition. These aren't the only sales and marketing expenses for Cash App on our P&L, though. There's also a portion of other sales and marketing costs related to peer-to-peer expenses, which don't factor into our acquisition cost, but we deduct them from gross profit as we measure paybacks and ROIs for Cash App. With that context, let's walk through cohort trends for Cash App. We're showing you 2 cohorts from different years, this time on a monthly basis. On the left, we have our July 2017 customer cohort. On the right is July 2019. We acquired them for $1.4 and $3.9 million in acquisition spend, respectively. Now let's look at these cohorts after their first 12 months. What you see here is the cumulative gross profit net of peer-to-peer costs for each of these cohorts. Similar to Square, both of these cohorts have more than recouped our initial investment for a payback period of less than 1 year. As we look at them after 2 years, again, you see their gross profit net of peer-to-peer costs growing over time. As we stepped up investment for the newer 2019 cohort, the cohort's size also grew significantly compared to the older one. The ROI on these investments is strong at more than 6 times return over 3 years. Similar to Square, we care about longer-term ROIs for Cash App as they reflect the cross-sell opportunity we see in our Cash App ecosystem over time. Unlike Square, Cash App's ROIs aren't linear. As we've grown Cash App's product set and achieved greater product adoption at little to no incremental cost, ROIs inflected as these cohorts matured. This trend has remained similar across years. From 2017 through 2020, you can see that we became more efficient at attracting new Cash App customers. Returns trended well ahead of 6 times ROI over 3 years. We believe this level was far too efficient. The lifetime value of our customers was increasing, but we didn't increase our investments at the same rate. We think we left opportunity for growth on the table. We started to right-size this in 2021. We've been ramping our acquisition spend across channels and intend to deliberately increase our cost of acquisition as we orient to ROI. As you can see, returns to date on our 2021 cohort are still pacing at a strong level, trending closer to prior cohorts. Cash App's cohort retention has supported these strong returns. Each of Cash App's annual cohorts achieved gross profit retention of more than 125% from 2017 through 2021. This means that from existing actives alone, Cash App's gross profit would have been growing 25% or more each year. And that factors in the impact from any actives that might have left in the meantime. Not only is each cohort growing over time, but we've been onboarding larger cohorts. The power of compounding here is immense. In their first couple of years, our 2020 and 2021 cohorts generated far greater gross profit compared to those in prior years, as product adoption rates in the first month of onboarding grew. Our ability to drive greater utility for our actives has also resulted in increasing Cash App engagement on a weekly and daily basis. In 2021, an average of roughly 2 out of 3 Cash App actives made a transaction on Cash App in a given week. And perhaps more impressive, 1 in 4 transacted in a given day. And we're evolving the design of the app to support discovery and more frequent interaction, which will continue as we integrate Afterpay. This growing engagement has driven greater monetization. As our actives use Cash App more frequently and adopt more products, they bring in more funds to use in multiple ways. This has driven greater gross profit, which has a strong correlation to the growth of inflows. Over the past 3 years, annualized gross profit per active increased roughly 2.5 times to $47 as of Q4 2021. We believe this has the potential to grow even further as we launch new products and as more actives are introduced to the existing products in our ecosystem. Our highest attached product currently, Cash App Card, is still only used by about 1 in 3 monthly actives. There is so much opportunity ahead. Let's explore an example of an ideal Cash App active. We'll take someone who starts by using peer-to-peer. Initially, they have a small network of friends to send and receive money. The average peer-to-peer active is generating some gross profit to get funds out of the app instantly every once in a while. When the active discovers that Cash App offers free rewards at interesting merchants, they decide to customize and order a Cash App card. At first, they only use it on transactions with boosts, but after a few months, they're using it almost every week on groceries, gas, and other regular purchases. They then check out investing, initially to read some articles, then to buy and sell fractional shares of equities, and to put some money into Bitcoin every week. By now, the network of their friends and family has grown, and they're sending hundreds of dollars in peer-to-peer transactions every month, including to local businesses using Cash App. They are now using Cash App regularly and across a range of tools. It's one of the first places they go when managing their money, so they decide to direct deposit their paycheck into Cash App. Cash App Card now becomes their primary way to spend and take out money from ATMs. This illustrates the journey a customer can take as they find more utility and eventually grow their lifetime value, in this case, to more than $200 in gross profit annually. This is multiples above what the average customer is currently generating. Not all of these products are monetized. Products like investing, direct deposit, and taxes are free, but they can drive more utility and ultimately inflows into Cash App. This is again why we measure unit economics on a customer level rather than a product level. For both Square and Cash App, our ecosystem approach allows us to be flexible with pricing and our business model, enabling different products to serve varied and self-reinforcing purposes. Not all actives follow the same journey as the example I just mentioned, but in aggregate, we have seen this growing adoption and engagement play out in Cash App's business model. As Brian shared, when customers use more products, they bring more inflows. And as inflows increase, that can drive greater gross profit. With only the current products in our ecosystem, we believe we have the potential to drive gross profit per customer multiples higher than what we're achieving today. As you heard from Brian, there are 3 ways we think about driving gross profit growth for Cash App: monthly actives, inflows per active, and the monetization rate, or gross profit generated on those inflows. Let's look at how these have contributed to Cash App's growth over time. From 2017 to 2019, the biggest driver of Cash App's gross profit growth was acquisition, or growth in monthly actives. In recent years, the growth algorithm shifted. From 2019 to 2021, inflows per active became the primary driver of gross profit. We've increased inflows per active in a couple of ways. First, by cross-selling, as customers use more products in our ecosystem, including the new products we added. And second, by driving greater engagement from customers on existing products. Growth in monthly actives was still a meaningful driver of gross profit over the past 2 years, but became a lower portion of the mix. Looking ahead, we have multiple ways to drive growth across each of these 3 levers. As we look at Cash App's revenue streams, we see that not only are they rapidly growing, but they're diversifying. Cash App has 3 scaling monetization streams: with peer-to-peer products, financial services primarily with Cash App Card today, and with Bitcoin consumer trading. Our newer revenue streams have been scaling quickly, and each of these have a growing number of monetized features within them. We'll continue to diversify this mix over time, both by launching new products and monetization streams, and by continuing to scale our existing products. Now that we've covered the cohorts in our Cash App and Square ecosystems, let's look at Afterpay. We believe Afterpay will be a strong complement to the cohort economics of Square and Cash App. From 2016 to 2021, we've seen Afterpay deliver positive volume-based retention, both with merchants and with consumers as well. More broadly, we think integrating and cross-selling Afterpay with our Square and Cash App ecosystems will be a strong complement to the lifetime value of each customer base, allowing our sellers to drive incremental sales and by unlocking commerce for Cash App consumers. Now that we've closed the Afterpay acquisition, we wanted to share more about how we're thinking about our balance sheet and our capital allocation priorities. We're in a strong liquidity position today. At the end of the first quarter, we had nearly $7 billion in liquidity available to us, including $6.3 billion in cash and equivalents and short-term securities on our balance sheet. Our cash position has benefited from strong free cash flow generation, which is a key longer-term priority for us. We're fortunate to be in a position of strength to think flexibly and holistically in how we manage our balance sheet and P&L. We think about the funding for each of our balance sheet products based on their unique performance characteristics around risk, return, and duration. For Square loans, we've proven out a compelling return with an ability to manage risk loss. We've sold the vast majority of these loans off our balance sheet to third-party investors to participate in the economics while also mitigating our own exposure. And we plan to continue with a similar approach going forward. Afterpay's Buy Now, Pay Later consumer receivables have a similar profile, with an attractive return and short duration, turning over 15 times per year. For now, we're going to fund these with a mix of cash and warehouse facilities, while also exploring other funding structures in a thoughtful way. More broadly, we also want to ensure there's room to experiment with products in new areas, like Cash App Borrow. As we test and learn about these products, we'll fund them with our balance sheet, but we'll also grow them with discipline and with the goal of exploring other funding structures over time. Now let's shift to our profitability. Before getting into this section, I wanted to briefly touch on the topic of guidance. Today, we're not going to share longer-term financial targets, a carefully considered decision based on two factors. First, our business is highly dynamic, and giving a growth target projecting many years out would have many puts and takes for us. Just look at our 2017 Investor Day as a case in point. We guided to 20 to 25% top-line growth. Since then, we've compounded overall company growth at more than 2 times that rate. As we scale with creators and Bitcoin to 4 ecosystems, with each at different stages, that dynamism only increases. Second, we want to maintain our focus on our purpose and our customers, and give ourselves the opportunity to react quickly to the trends we see in our business. We want to make the right long-term decisions for our customers and our business, and we want to do this while maintaining rigor and discipline around our investments. What I just walked you through around our cohort economics, acquisition, retention, ROIs, form the pillars around our investment decisions. We invest when we see attractive returns, and we're prepared to scale back on investments when trends change, as we've done at various points in our past. You've seen the results of this in our track record of performance. We are also sharing more on what we're investing in and why. We intend to hold ourselves accountable to driving long-term profitable growth at significant scale as we invest in our business. So we focused our disclosures today on areas that align directly with what we're investing in. We'll continue to provide transparency on real-time trends in our business, as we have on our recent earnings calls. With that context, I'm going to walk you through our investment framework and the structural profitability of our ecosystems. We'll start with the investment framework. We look at our business as 3 distinct investment opportunities: the Square ecosystem, Cash App ecosystem, and our emerging initiatives. Square and Cash App are more established businesses which have found product market fit and have scaled business models. We evaluate investments here independently based on their intrinsic merits of driving long-term profitable growth and strong ROI. Our more nascent businesses fall into the emerging initiatives group. Cash App was once in the emerging bucket and has obviously grown well into its own, a path we hope to see over time for our businesses focused on creators and Bitcoin. These groupings dictate how we organize and allocate our resources. Each ecosystem makes holistic decisions around their teams, roadmaps, strategy, and investments separately and in parallel. This enables us to move quicker and be dynamic with our investments. It also means that the decisions of one ecosystem don't constrain the other. And of course, teams are still collaborating across ecosystems where it makes sense, particularly to build durable connecting points between them. We evaluate our more mature ecosystems based on a framework of growth plus margin, or gross profit growth plus profit margin. This helps balance trade-offs where we have opportunities to invest for growth and levels the playing field for businesses with different growth and margin profiles. We believe a dollar invested today should return profitable growth over a period of time because that invested dollar is going towards reaching and building value for our customers. Now, how has this investment framework driven the profitability we see in our established ecosystems? Let's look at the margin profiles of Cash App and Square today. We're showing you a new metric here called Adjusted Fully Burdened Profit Margin. Here we've taken all the expenses that directly impact each of Square and Cash App, And we've added allocated expenses from corporate teams who work across the ecosystems, like finance, legal, and people. Together, these operating expenses make up the vast majority of what's in our P&L, although we're not including stock-based compensation. Looking at our 2021 performance on this basis, you'll see that each of our ecosystems drove strong profitability. Square at 34% and Cash App at 12%. If that's a fully burdened margin, let's now look at structural margin to get a sense of the structural profitability inherent in each ecosystem. We've grouped our operating expenses into fixed and variable. Variable expenses are what we incur to drive the next dollar of gross profit. Fixed expenses are investments that may drive longer-term growth, but don't scale with an additional dollar of gross profit. This exercise helps illustrate the strong incremental profit our business can generate as we scale, and where we make purposeful investments to drive long-term growth. In the fixed bucket, we have R&D investments across our product, engineering, data science, and design teams. And we also have operational overhead. On the variable side, we have our customer acquisition investments, including traditional sales and marketing spend. And we have ongoing expenses to manage the business, including customer support, risk loss, and Cash App's other sales and marketing expenses. For now, we're considering all discretionary sales and marketing as variable, but longer term, this is an area that could be fixed as we flex here as well. Square had an incredibly strong structural margin of 69% in 2021. This means that variable expenses were only about 30% of Square's gross profit. What does this structural margin mean? On the incremental dollar of gross profit, there's 30 cents of variable expenses to generate that growth. And with the other 70 cents, we can either reinvest that back into our products or overhead, or flow it through to profits over the long term. This structural margin has held in a similar range for Square from 2018 through 2021, with only a modest decline in 2020 during the pandemic. Where are we investing against this profitability? For Square, it comes back to the 3 strategic priorities Alyssa highlighted: omnichannel software, global expansion, and growth upmarket. We're investing across product development to build new products and enhance existing ones, and sales and marketing to drive awareness across global markets and increasingly upmarket. Cash App has seen a strong trajectory in its profitability. Cash App's structural margins are lower today given the variable expenses in its business, including peer-to-peer processing, risk loss, and card issuance costs. Still, we've been able to improve Cash App's structural margins over time. As we've expanded our ecosystem, driven product adoption, and added new monetization streams, Cash App's structural margins have increased from less than 10% in 2018 to roughly 37% in 2021. And we see further opportunity for expansion over the longer term. For Cash App, we're investing into 3 strategic areas. First, new product expansion. Of Brian's 7 pillars, the 2 I'd emphasize are commerce, including the integration of Afterpay, and financial services, where we're broadening the product set. Second, customer acquisition. We're focused on growing with higher lifetime value customers, and we want to reach global audiences by bringing our ecosystem to new markets. Finally, we're focused on bringing inflows into Cash App by adding new inflow channels and investing in our infrastructure around deposits and limits to make it even easier to bring your funds into Cash App. Now let's shift our focus to the fixed expenses in our overall business. Here we've driven meaningful leverage since our IPO and as our business has scaled. As we look ahead, we don't anticipate further leverage from fixed costs in the near term, given the addition of Afterpay this year and our scaling emerging initiatives. But longer term, we believe we have the potential to achieve additional leverage on this fixed expense base. Now, turning to our emerging initiatives across our younger creator and Bitcoin ecosystems. We're bringing a similar disciplined approach to evaluating these initiatives, using both operational and financial benchmarks. From an operating perspective, each of the specific business areas within these ecosystems have 2 check-ins per year. These are deep dives with relevant stakeholders across the company into their progress across several fronts, including the team, product roadmap, business model, and go-to-market approach. We use these check-ins as an opportunity to monitor and quickly respond to trends in the market and our own progress, so we can double down on the things that are working or pivot where they aren't. With regards to financial investment, we're using parameters that one would use for early-stage businesses. We want to enable these teams to refine their approach, to invent and learn about their products and customers, but to do so in a disciplined way. So we've implemented an investment envelope for these businesses that for 2022 equates to 3% or less of our non-GAAP operating expenses. We used similar constraints when scaling Cash App in the early days years ago, which helped the team think creatively around products and monetization. We believe we're in a unique position to scale these ecosystems, and these parameters can help us iterate quickly in a prudent way. Before we close, I want to come back to where we started. We are so early in our opportunity, at less than 3% penetrated in a nearly $200 billion addressable market, one that continues to grow behind secular tailwinds that we believe favor ecosystems like ours. The macro environment we sit in today is as dynamic as ever for consumers and sellers, between inflation, supply chain, and recessionary concerns. If there is anything the early days of the pandemic taught us, it's that this is exactly the sort of moment in which our ecosystems can shine. Our ecosystems span multiple audiences. Within each ecosystem, we have a diverse customer base across sizes, geographies, verticals, and demographics. These customers hire us for multiple jobs to be done, which provides greater value to them and can add resilience to our business through more monetization streams. These can be enduring revenue streams, particularly in an inflationary environment, as our pricing models are mostly variable and grow with volumes. We believe the secular tailwinds we talked about earlier allow us to gain share, not in spite of, but because of a shifting macro environment. For sellers, the ability to expand into new sales channels, reach and engage new customers, more efficiently manage staff, and have one cohesive view of their business becomes even more important in periods of disruption. We believe the value of a software and integrated payments platform like Square's will only accelerate as a way for businesses to improve productivity and adapt quickly. For consumers, the last recession catalyzed fintech adoption. People shifted to manage their money on more modern platforms, driven by the younger next-gen consumer. In these dynamic times, we believe Cash App's focus on building intuitive products and providing fast access to funds becomes even more valuable. We are in a moment where consumers need us now more than ever. And among our emerging initiatives, Bitcoin adoption and the creator economy have continued to see rapid growth. It's early days here as the world increasingly moves towards people wanting to take control of their craft and their finances. Downturns are often catalysts to seismic shifts, and we want to be ready for future transformational opportunities. Before we turn to your questions, I'll leave you with the attributes I shared earlier today that we believe truly differentiate Block. With our ecosystem of ecosystems approach, which spans beyond just payments and across multiple industries, we are creating something entirely new, a category that doesn't yet exist. We're building a multi-dimensional company, serving a growing set of customers in pursuit of our purpose of economic empowerment, and in an integrated fashion. We have profoundly outgrown the company we were at our last Investor Day 5 years ago, and I can't wait to see what the next 5 years brings. Now, let's take your questions.